update. Lucky you, we have lots of fun stuff coming up. We've got Ken Senus and Michael Dvorak, two credit union executives. Kenneth is the president and CEO of St. Mary's Bank, and Michael is the CFO of Service Federal Credit Union. They're going to be joining us right after the news break here at 7 to talk about the banking. And what the heck's going on with Silicon Valley Bank and the banking system in the U.S.? Is it fragile? Should we be worried? Where should you park your money? And when you're thinking about big regional banks and huge national banks and little tiny banks and credit unions, how do you think about that? What's safe? What's at risk? So we're turning to some local credit union folks to give us the lowdown on that. And that's coming up right after the break. Then we're going to have attorney Corey McDonald.
It's Drew Klein with the WFEA Morning Update on 99.9 and AM 1370 WFEA.
Silicon Valley Bank failed, and they're not just in Silicon Valley. They had a bunch of folks in Boston, even investors in New Hampshire. We've had other bank failures. Everybody's freaking out. So we're turning to some local calm folks who might be able to help explain us what's going on. Ken Senus, president and CEO of St. Mary's Bank, and Michael Dvorak, the chief financial officer of Service Federal Credit Union. Hey, thanks for joining us.
Well, thank you for having us. Yeah, great to be here.
All right, my first question for Michael. Since St. Mary's Bank was the first credit union in the U.S. and Service Credit Union was founded in the 50s, does Ken ever, tease you or hang it over your head that they were first? No.
I would never do that. Would I, Michael? No, you wouldn't. You're a big guy, Ken.
All right,
it's people helping people here at credit unions. That's right.
Okay, you're all on the same team then. Okay. All right, so let me. I'm going to pose this to Ken first with St. Mary's Bank, and then Michael, you can chime in. And I'm doing this just so the listeners can follow who's who here. Let's take Silicon Valley Bank. What is your take generally on why SVB failed? If you can give us a really short synopsis, and whether the federal response is appropriate. That make sense?
Yeah, Drew, I'd be happy to take that one.
Sure.
It really, when you look at the makeup of their balance sheet, they had extreme concentration risk, right? Really on the fintech side, crypto, but one of their biggest, it's two other big issues that really caused the failure. First, they did a lot of investments in long-term securities. They put it out there way too long, and then interest rates started going up, and it really started hurting the financial position of SVB. To compound it, they just had so many of their deposits were uninsured. They had very large depositors. So, got 90 to 95% of their deposits are uninsured, which is really kind of symptomatic of causing a bank run when they started having some financial difficulties. So that's really what was the biggest issue that they had. Yeah, and Drew, I would just add that, their business model in moderation was probably sound, right? And as a publicly traded company, they're trying to maximize returns for their shareholders. And so there's always this motivation to kind of double down on a successful business model. And in banking or the credit union space, that can tend to get you in trouble. And as Ken said, they were very heavily concentrated on the deposit side and on their investment book. And I think Warren Buffett once said that when the tide goes out, you find out who's been swimming naked.
Yeah.
And that's what happened when the Fed started to pull back on all the liquidity and raise interest rates, is that their longer-term investments became worth much less. And as their customers, the technology sector, started to not have quite the growth trajectories that they once did, and their customers started to draw deposits out with today's social media, that turned into a run. So, credit unions have a much different model. We're geared toward our members, and our shareholders are our members. So
We try to return those profits in the form of more favorable rates and lower fees, and invest in our communities. And just the fact that we are investing in our communities tends for us to encourage diversification on our balance sheet to guard against the concentration risk that Silicon Valley banking had.
Yeah, and that's kind of leads to my next question, because SVB Bank was really focused on extremely rapid growth and all these SPACs and, investors in growth companies and all that kind of stuff. For a credit union, it doesn't seem to me that credit unions tend to have that kind of approach to growth of the institution. You want to get a little bigger, you open another branch here or there. But can you describe your approach from the credit union point of view to how big you want to get? What is it? We never see a credit union of America, right? You just you don't see that. So what is your approach from the credit union side here to getting bigger?
Yeah, I'll grab this one, Drew. This is Ken. It's really, when I say slow and steady, right? Our mission is to really serve the communities that we're in, and it's not about just growing to be bigger. It's about serving the members, and if there's a need out there that we could fill, both in a community and for the members in that community, we will look at that area and we'll look at growing. But we have different restrictions. We have a lot of credit unions have field of membership restrictions. You could only go in certain counties or areas or lines of business. So again, it's slow and steady, but we definitely we like to grow because there's some benefits of growing and be able to offer the newer technologies and keep up with a lot of the larger institutions. But it's also, you don't want to grow too fast, right? Because we're all about the community.
Yeah, and is that a regulatory issue about where you can and can't go and your membership growth, that kind of thing, or is that just a
it
structural?
Yes, credit unions have field of membership restrictions, and again, it really kind of limits you, whether geographic limitations or the old credit union model was segment based, right? If I was with the telephone company, it would be the telephone company credit union. So it really there's so many different rules, and it's really based on each specific credit union.
All right, so I'll tell you what, let's take a quick break here. I have a lot more questions for both of you, and we'll come back and do that right after the break. We're with Ken Senus of St. Mary's Bank and Michael Dvorak of Service Federal Credit Union, helping us understand this whole financial mess the country seems to be in. And we'll join them right after this short break on 99.9 and AM 1370 WFEA.
It's the WFEA Morning Update with Drew Klein.
Hey, we are back with Ken Senus, President and CEO of St. Mary's Bank, the nation's first credit union, and Michael Dvorak, CFO of Service Credit Union. And now that I have you two credit union gurus here, I want to pose a scenario for you so you can explain to our listeners where you invest their money, the deposits, because this was a big issue with Silicon Valley Bank. Where are the deposits invested? As we all know from It's a Wonderful Life, you don't have a big vault full of cash. The money is in Tom's home and, Mary's home and all that kind of thing. In It's a Wonderful Life, Tom comes up and asks for $250 back. But that would be $4,000 in today's money. As a credit union, where's that $4,000? Where do you guys invest it to get the returns you need to keep your bank, your operation going?
Yeah, Drew, I'll take a swing at this and let Ken chime in. Primarily, we are investing, just as you say, in people's homes, in people's businesses, and people's cars in our communities. That's first and foremost our priority is to support those communities through loans to our members. Now, similar to Silicon Valley Bank, we will invest in investments as well, but generally speaking, that's a very small part of our balance sheet, and they're all investment-grade bonds. So there'll be treasuries, there'll be government-backed mortgage securities, and the like. Many are backed by the government itself. So the credit risk on those securities is very, very good, as we've seen in the Silicon Valley Bank. When interest rates change, the value on those securities can change. So, that is why we're extremely careful. The regulators more than encourage us to be extremely careful and conservative in our investments. But again, first and foremost is supporting our communities through our members' lending needs.
Ken, is that...
And Michael...
Yeah, go ahead.
I'll just jump in. This is Ken. I think it's very important, looking at our business model. And, as we both talked about throughout the segment, I mean, we are a member-owned credit union. And I think that the biggest thing that is a differentiator is, we're about the people and our members, not over just profit. So, where we don't have the shareholders, we have the member-owned, that we're taking care of the people. We're taking care of Main Street. We're taking care of the members through loans. So our investment portfolio is a lot different than banks. We're not taking risky investments. We're not going in to certain different industries that, could be construed as a little riskier. We're giving the people down the street a new car or their house and making an equity loan so they can do repairs. That's our investment. We know where the money's going.
So how do you deal with the interest rates going up in the last year? Because as Michael said, you do have some sort of this really secure investments. They're government bonds or maybe they're mortgage-backed securities. Those all have government backing. They're pretty safe. But the value goes down when interest rates shoot up as fast as they have. From a credit union point of view, how do you manage these rising interest rates?
Yeah, the nature of banking or credit union is to take in deposits which are more short-term based and lend them out, which are more long-term based. So, Drew, just as you indicate, in an economic environment or a credit cycle like we're in, when interest rates are going up so quickly as they have in the past year, I worked at the Federal Reserve for a number of years, and we have never seen interest rates rise to this degree, 4.75% over a year's period of time. And so what you do when you manage the balance sheet in that kind of environment is to try to minimize that mismatch between your loans and deposits and keep loans on a shorter term basis.
Right.
And you can do things like participate out your longer term mortgages. You can, move toward adjustable rate mortgages, all reducing sort of that maturity span of the loans that you're offering. And we do it on the investment side as well to minimize, the length of that maturity and the overall duration of our portfolios. So there are a number of things that you can do. Now, no one expected rates to go up 4.75% in a year. I don't even think the Fed did.
Yeah.
And so it was a surprise to everybody. But once you sense that you're in that kind of environment, you start to make those types of shifts.
Well, before we have to go, I wonder if each of you can maybe give folks, I don't know, some reassurance. Where do you see banking in general going in the United States right now? Are we in a really sort of risky period? Are people rightly concerned? And when you're looking for a place to kind of park your money, like if you had I heard this on a podcast, it's not my original idea, but if people had $1 million and they had to put it in a financial institution and invest it, they couldn't just put it under the mattress. Where's a good place what should they think about doing with that and to avoid risk, I guess would be a good way to put it. And we can end with that.
Yeah, I'll of course, right? Michael and I are both on the credit union side, and I just saw a Fox News article just last night that said, I mean, look at your credit union. I mean, we are a different business model. Part of the reason that SVB had the bank run was because they had so many deposits that were uninsured, which is just symptomatic of something like that can happen. With the New Hampshire credit unions, and you look at year-end 22, only 7% of the deposits were uninsured. So the risk of any kind of a run is extremely negated. In addition, again, we know where our investments are. We know, who we're lending to. We have sound management practices to make sure that the money is safe. So, I don't think there's going to be a major crisis. I think there was some mismanagement by some larger institutions. They could have did things better, but I don't think we will see a large number of additional collapses, if you want to say it that way.
All right.
I completely agree with Ken, and I think Ken gets at a great point. It's that transparency as to what these financial institutions have. I think that our members can take comfort in the credit union model and the stability of it, as we've discussed today. But, in this age of information that we're in, I think potential depositors, Drew, as you've described it, of all sorts are going to be asking for more information about that bank, about that credit union, so that they can assess to some extent for themselves how safe and secure these institutions are.
Yeah. But, that's a good note to end on, Michael. I'm sorry, I wish we had more time, but we're out. So I really appreciate you both joining us, Michael Dvorak of Service Federal Credit Union and Ken Senus, President and CEO of St. Mary's Bank. Hey, thanks for your time. This was really helpful.
Thank you very much.
Thank you, Drew.
Have a great day, Drew.
All right, you too, and appreciate your insights here. Great takeaways. We will be back right after this short break on 99.9 and AM 1370 WFEA.